previously on Financial Self-Reliance YouTube channel. And then when it was time for me to get my credit score back up, I went and learned how to increase my credit score, which will be the topic of another video at another time. So how would you like to be able to increase your credit score by several hundred points? Before you can really increase your credit score, you need to understand a few things about how credit scores work. Your credit score is kind of like your report card now that you're out of school. So if you're getting good grades, you're going to have a high report card. If you're getting bad grades, you're going to have a low report card. So let's make sure that you understand exactly what it takes to get a good credit score, and that will help you to build your credit score even faster so that you can have as high a score as possible. There are significant savings by having a high credit score, and I'm going to share with you an actual calculator that shows you how much money you can save by having a higher credit score. The lower the credit score, the more you'll pay. The higher the credit score, the less you'll pay. If you can pay less for the same thing just because you have a higher credit score, I'd highly recommend getting as high a credit score as possible. Welcome to the channel. My name is Paris Clough and this is Financial Self-Reliance. I absolutely love helping people manage, protect, and grow their money. Please hit the like and subscribe button if you get value out of this video. It will help the channel grow and it will help get the word out so that we'll have more people that are financially literate and financially self-reliant. So let's talk a little bit about credit scores. Many people call them FICO scores. FICO is an acronym and it's for the Fair Isaac Corporation. This score was created many years ago for lenders to determine how likely a borrower was to repay a loan. It also gives you as the borrower an idea of how much you're going to be charged as an interest rate, how much a lender is willing to lend you, and how long they're going to lend you that money and be willing to have you pay them back. So if you're ever going to borrow money, which you're probably going to do if you ever want to buy a car or buy a house, or if you want to get a credit card, you're definitely going to want to know what your FICO score is. There's many different ways to calculate your credit score. The FICO score is the one that's most common. We're going to talk a little bit about another way to calculate your credit score, which is called the Vantage score, which is through Credit Karma. Credit Karma is the free credit monitoring service that I use. All right, so let's go to the myfico.com. That's the website that kind of discusses FICO scores. And what I want to go here is I want to go to how scores are calculated. So the first thing is a FICO score is calculated by 35% of your score is based on your payment history. That's if you pay on time, if you're paying late, how late you're paying. And so it's important to make sure that you're paying on time so that your payment history looks good, because that's the biggest percentage of what goes into your score. The next thing is how much money you owe. And we're going to break these things down individually. How much money you owe is 30%. The next thing here is new credit. How much new credit do you have is 10%. And the length of credit history is 15% of your score. And the credit mix, meaning having different types of credit in your credit history. So let's take a look at each one of these things. First, payment history. All right, so what is payment history? We kind of went through that here at the beginning. Let's take a look at the types of accounts considered for credit payment history. Credit cards, retail accounts. Those are basically credit cards from a store, the specific store. Installment loans, finance companies and accounts, and mortgage loans. So if you're paying on time, you're going to be good, especially if you have these on your credit score. Are there any public records or collection items? Are there any bankruptcies or lawsuits or wage attachments like child support, things like that, alimony? All right, so here's some tips to enhance your payment history. Number one, pay your bills on time. Number two, get or stay current on your missed payments. So get back on track with your current payments. If you've missed any, call up some of your creditors if you need to. That's the next step here. Contact creditors and get some help. If you have had a creditor that you owed money on many years ago, don't necessarily just start paying all of a sudden. Call them first. Get on the phone. Maybe work out a payment schedule outside of the credit history reporting situation so that you can actually get that debt paid for and then make sure that it gets cleared off of your credit history if it gets paid off. All right, the next thing, let's take a look at amount of debt. So the amount that you owe determines 30% of your FICO score. There are 5 factors that the amounts owed category looks at. One is the amount owed on different types of accounts. So if you have a mortgage account, if you have a credit card account, if you have a car loan account, those are different types of accounts. So it's looking to see how much you have in each one of those types of accounts. How many accounts have balances? So if you have 10 credit cards and all of them have a balance, your amounts owed is going to be affected a little bit there. If you have 10 credit cards but only owe on 1 or 2 of them, that's going to be more favorable. Here's something that's critical to realize. Credit utilization ratio on revolving accounts. So let's say that you have a total limit on your credit card of $10,000 and you use $1,000. You basically used 10% of your credit limit. So your credit utilization ratio is 10%. If you have $5,000 that you've used on that credit card, you're at a 50% utilization ratio. The higher the ratio, the lower your score. The lower the ratio, the higher your score. A lot of people, when they get a lot of credit cards, they don't want to have those credit cards and they start closing them down. And that's actually going to affect your credit credit report negatively, because if you have a bunch of credit cards and they're open balances but you never use them, it not only takes a look at the percentage on each individual account, but then it aggregates or looks at the whole credit utilization based on all of the accounts that you have open. So let's say you have 5 credit cards with a $10,000 limit. That's $50,000 of available credit to you. Let's say you have that same $5,000 limit on the one card. So on one card, you have a 50% utilization ratio, but overall, because you have $50,000 available to you, but you're only using $5,000 on the one card, your overall credit utilization ratio is only 10%. So that's positive, and that helps your credit score go up. All right, now the next one is length of credit history. So the length of your credit history accounts for 15% of your credit score. That's not a huge amount, but 15% can be a significant percentage, and it's important to keep track of how long you have your accounts open. So if you had an account that's been open for 10 plus years, you want to keep that account even if you're not using it anymore, because it gives you an average age of your credit history that's much longer. All right, the next one is credit mix. Now this is only 10% of your FICO score. So credit mix includes credit cards, retail accounts, installment loans, finance companies, and mortgage loans. So having an account or 2 or 3 in each one of those categories is probably a really good idea. Many years ago, I used to be a loan officer for a mortgage company, and one of the things we would look at was how many credit lines they had opened and if they were in different types of credit. So if somebody had a car loan and a credit card, that was excellent because they had 2 credit lines and they were different. One was an installment with a car, and one was a retail or a credit card that gives you the ability to kind of see how you handle different types of debt. Credit mix is basically the different types of accounts that you have, so it's good to have a variety of accounts so that you can get a strong credit mix that will help you boost your score. Now, new credit makes up 10% of your FICO score. So new credit is things that have happened in the last 12 months. So one of the things you're going to look at is how many new accounts have you opened in the last 12 months, and then how many recent inquiries have you had. So what they call is a hard inquiry is when you go to apply for a credit card or for a loan and they check your credit, that's often a hard inquiry. And if you have a lot of inquiries, they're going to lower your credit score a little bit, because those inquiries means that you're applying for debt and you're applying for loans. Now, one of the key things to remember here is that if you are applying for the same kind of debt, meaning if you're going to different mortgage companies and you're shopping around and you're trying to get a better rate or a better deal, credit scores and credit companies recognize that, oh, we got one hit from a mortgage company. The second hit is also from a mortgage company. So they're not going to double ding your credit because they recognize you're shopping for a mortgage. Now, if you're shopping for a mortgage and you're shopping for a car and you're shopping for a credit card, now they're like, what is this guy doing shopping for so much debt, trying to get into debt? So new credit is 10% of your overall credit score. A couple videos ago, I shared with you that I went from a mid 500s to a mid 700 credit score. So I wanted to share with you and show you that right now my TransUnion score is 773 and Equifax is 799, so I'm right under that 800 mark, which is pretty awesome. So Credit Karma is a great way for you to be able to monitor your accounts. I'll leave a link in the description below. What do you use to keep track of your credit score? On Credit Karma, it's a little bit different. We can see here that traditional FICO scores are scored this way. We just went through that. But under Credit Karma, they do, instead of a percentage, they do extremely influential, highly influential, moderately influential, and less influential. So it's important to get an idea of how each company is monitoring your credit and how they keep track of things and how they give you a score. All right, so the last thing I want to show you is what's called a loan savings calculator. And this will basically tell you that depending on the credit score you have, you will get a better interest rate. And by having that better interest rate, how much money you will save over time by having a lower interest rate, meaning you'll pay less interest. So let's take a look. So if you had a 30-year fixed mortgage and you lived in the state of California and you had a $300,000 mortgage, the average home price is about $350,000. So if you put some $50,000 down or so, let's say you're going to be borrowing $300,000. So you have a $300,000 loan, and based on your credit score, you're going to have a better interest rate. So if you have a 620 to 639 credit score. By the way, most lenders, especially for mortgages, you're not going to get a loan if you don't have 620 or higher. Some of the car lenders will let you have a 620 or lower, but you're not going to get these kinds of rates. You're going to be maybe in the double digits. So make sure your credit score over 620. So from 620 to 639, you can see 5.223, which means your monthly payment will be $1,600, and you will pay a total of $294,000 in interest, just in interest. You'll pay the $300,000 back of the loan that you borrowed plus $294. So basically you've doubled how much money you pay for that house. Now, if you just get a better interest rate, you can see at 760 to 850, your APR is 3.622, your monthly payment is $1,368, and your total interest paid is $192. If you look down here under step 4, so I'm put down here the lowest score. So if you have the lowest score possible, which is 620 to 639, this is going to show you exactly how much money you would save. So if your score was just jumped to over 640, you'd save $36,000 over the course of that loan. If your score jumped to 660, you'd save $63,000. 680, you'd have $77,000 in savings, and all the way up here to 760. If you had a 760 or higher credit score, you'd have saved over $100,000. So you tell me, does it pay to have a better credit score? I would say so. One of the things that I would do is, if I were you and you were just right now starting out to get a good credit score again, is walk into a bank or a credit union and ask them to have what's called a secured credit card. A secured credit card is when you deposit money that they actually use in case you default. So they already have the money up front. It's like a prepaid credit card that allows you to build credit with your own money. That's one of the things that I did to help build my credit. So I put down the money, they used that money as collateral. They gave me the credit card. I started to use the credit card for things that I would already buy. If you're gonna get a credit card, don't you dare buy things that you can't afford, especially if you're trying to rebuild your credit. Because what you wanna do is you wanna charge your gas, for example, or charge your food, things that you would pay for. Just charge it, build up a little bit of a balance, let the credit bureau report that, and then pay it off every month. If you pay it off every month, if you charge it up and then pay it off and charge it up and pay it off, your credit score will increase dramatically. If you do that for a year, often what they'll do is they'll increase your credit balance. You've shown that you can be trusted with a credit card, so they're going to give you your secured deposit back, and they're going to allow you to have what's called an unsecured credit card. And that's when you really start to build your credit even faster. The next neat thing is that as you build your credit, you're going to get other credit cards. And the more credit cards you have, the more lines of credit you have, the faster your credit will grow. I hope this video helped you learn how you can increase your credit scores, maintain a high credit score, and why it's important for you to get as high a credit score as possible. You're going to save tens of thousands, if not hundreds of thousands of dollars over your lifetime by having a high and good and strong credit score. If you missed the last video I created, you can find it here. Go ahead and subscribe to the channel up here and check out the video that YouTube thinks you might like. I hope you have a great day, and I look forward to seeing you on the next video.